In today's video, we're going to analyze what the downgrade in the US credit rating actually means for the economy and why that's not a good thing, of course, right? Now, we're also going to analyze why the average consumer in America is not in a good spot. The credit card debt, the 401ks being withdrawn at alarming rates. There's a couple of things unfolding, and we're going to analyze how that's going to impact the economy as well as the housing market. Now, the first article I want to go over is the CNBC article. Credit card debt tops 1 trillion for the first time. This is going to be a huge test for cardholders. Well, of course it's going to be a huge test because it's the first time we've ever hit a $1 trillion mark in credit card debt. Now, credit card debt alone would not be an indicator that the average consumer is not doing too well and that the economy could potentially be heading down to a cool down. But this right here, if we analyze this, Americans are pulling money out of their 401k plans at an alarming rate. Now, not only do we have a milestone that we had, not a good one, $1 trillion credit card debt for the first time, but Americans are also pulling 401ks at an alarming rate because they can't make ends meet from the inflation attack that we've been under. Now, this kind of data information you're not going to find anywhere else. Do me a favor, smash that like button down below, help me grow this YouTube channel, and remember, Dinko the Realtor has your back anywhere in Utah. If you're looking to buy or sell, my contact information is down below, and again, Dinko the Realtor has your back anywhere in Utah. Now, Americans pulling out their 401k plans at an alarming rate with the credit card debt, and right here is going to be the Fitch downgraded, and it's actually potentially worse than 2011. Now, that's not a good indicator. So right here, this sentence, US debt is at a much riskier territory than when the S&P lowered its rating in 2011. People keep saying this isn't going to be 0809. Well, for one, nobody knows if this is going to be just as bad or worse or anything close to 0809. Now, 0809 should not be the measuring stick. If we get half of what we had in 0809, that is not going to be a good recession. Now, I want to scroll down here and show y'all why this is actually an important thing. So right here, the risk, rather than its deficit, it's the deficits and the interest rates feeding back on each other and growing costs to both the economic growth and the taxpayer. Well, the credit card, the interest that we're paying, it's about $700 billion that the US government is paying per year on its debt. Now that is an enormous amount of money. Well, if your credit rating just got downgraded, and right here it states that that could be a cost to the taxpayers, well, what does that mean? That means that debt to refinance, to finance is going to get more expensive for the US, and us, the taxpayers, are going to have to pay for that. Now, what does that mean? It means less money in the economy. If we have the student loans turning on, that also means less money circulating in the economy. People are now going to start making their payments. Yes, it seems like there's not going to be any late payments for a year. It's not going to be reported to the credit bureaus for a year, but the interest is going to start accruing. So you're going to have people that are not going to want that interest accruing on their student loan. And now, if the interest rate that the US government has to pay on the debt is higher, that means there's less and less money circulating in the economy. And we're not even going to get into the car bubble, into the commercial real estate issues that are arising with the refinancing debt going on there with the variable loans. There is a lot unraveling in the economy that is not stating that everything is perfect, that everything is peachy and dandy. And the consumer, the average consumer, as we're seeing right here, is struggling with their debt. They're not being able to make ends meet. I want to show y'all this right here as well. The personal savings rate in the US is 4.3% for June of 2023, and that's down from 4.6% in May. This is now a far outreach from where we were at the height of the COVID pandemic, where the average American was saving 33% of their disposable income in April of 2020, and that money is starting to disappear because people have been tapping into that enormous savings. We also have had record-breaking travel, which means people have been tapping into that savings. And also with inflation, again, the average consumer has been tapping into that savings account. Now, right here, if we take a look at this, since 1959, the average personal savings rate is 8.8%. Well, we're only at half of that now. That is another signal that is indicating that the average consumer in America is not making ends meet easily. The credit card debt, the 401ks being pulled, and now the savings rate is being down. Those are three pretty good indicators that the average consumer is not in a good spot. Now, consumer spending is the #1 GDP for our economy. It's the biggest part of our GDP. Well, if we start having the student loans turned on and we start having unemployment rate, if things kind of trickle down, that is not going to be signaling that things are good. I hate when people say everything is great, don't worry about anything. You can't say that because there is things that are still unraveling and nothing has fully developed yet for anybody to say that, hey, this is going to be 100% okay and don't worry about anything. You have to make financial decisions on data and you have to be comfortable with the financial decision that you're making. If you're not comfortable with it, look at the data, analyze it, see what you would be more comfortable. Let's say that things really don't go down, there is really no major correction and things start going up. Would you be more comfortable if things went up a little bit and maybe the interest rates came down a little? Or what if things just tumble down? So you got to kind of analyze it. And this is why in the previous video, I've said things are mimicking last year. Prices have kind of just stagnated on home prices, and they're looking like they're about to start dropping as homes are now just lingering on the market, resembling what happened last year. And that is resembling that October and especially November and December is going to be the best time to buy again this year, just like it was last year. And remember, all of this is happening with a historically low unemployment rate. Again, historically low, which means that this is not the norm. So what happens when unemployment rate goes up to 4.5%? Does that kind of spiral things, and does the unemployment rate then go all of a sudden to 5.5%? That's why we have to let things unravel here. Now, right here, the Fed wants a good inflation report, but they do not want a good job report. Now, that's conflicting, right? Like, why would the Fed not want that? Well, there's a very good reason, because they don't want inflation to look like it's getting under control, them to kind of, just let things go back to normal, start cutting the rate, and all of a sudden people just get all the jobs back, jobs start paying more and more, and all of a sudden inflation is an issue again. They would rather overcorrect than having to have a double whammy, which could actually cause things to be a little worse. Just like how things were not looking that good in the fall of 2022 and into the holidays of 2022, and then things in the spring and the summer, everybody kind of forgot about that. Well, let's say that we do have a correction in the housing market, in the economy. It could potentially be a little worse now because people started investing and they were saying, hey, I'm just going to forgo the crash. Nothing's going to happen. There's not going to be no correction. And I'm just going to live my life. I'm going to go buy a car. I'm going to invest in my business, whatever they're doing. And remember, they're doing this at high interest rates that have been the highest for like the last 20 something years. Keep all of that in mind as we're kind of progressing through this. Now, things are not all great. If we take a look at this article by MarketWatch, Moody's places credit ratings of 6 major US banks on review for downgrade. Now, we had a financial issue in the economy with a couple of big banks collapsing. And everybody thinks that that's all over with. And then now we're seeing that there's a potential of 6 major US banks being downgraded. Well, that's not a good thing for these banks, because now for them to finance their debt, it's going to cost them more. They're going to have to pass that on to the consumer. There are things that are not indicating that we are in a 100% good spot. This can impact housing. This can impact unemployment. This can impact the economy. Subscribe. Follow me, hit that like button, help me grow the YouTube channel, and remember, when you need a realtor anywhere in Utah, Finco the Realtor has your back.